did you? Anything you want.
One of the greats says it may finally be time for gold and silver to move higher. Today one of the greats said it may finally be time for gold and silver to move higher. Waiting on the FOMC. By Bill Fleckenstein, president of Fleckenstein Capital, the market was quiet and just slightly higher through midday, with nothing remarkable worth reporting, other than the undertow was at work again in the chip sector. In the afternoon, little happened, and when I had to leave, with an hour to go, the indices were mixed and not far from unchanged. Please check the box scores to see if anything happened in the last hour. Away from stocks, oil was flat, green paper was mixed, while fixed income was weaker again, with the 10-year now yielding approximately 3.1%. The metals were higher, led by silver, which gained 1.5% to gold's fractional gain. Rate and see. One would think that tomorrow's rate hike should have been discounted by the metals complex, which seems to be the only place higher rates matter, even though, historically, they have not been negative for gold. But if we have constructive market action in the wake of the meeting, it might finally be time for the metals complex to move higher. On the mining front, for the second day in a row the combined entity of Barrick and Randgold traded higher, which I think is a positive development. Included below is one question and answer from the Q&As with Bill Fleckenstein. Let them eat cake question. Last week someone wrote in about how kicking the can down the road might lead to social unrest. I see it coming. At the turn of the century, in spite of poor policies, we were not that bad off, but the desire of the Fed to avoid even a mild recession, and I must add Carter does not get credit for putting Volcker in charge of the Fed. Imagine if he had put Easy Al in charge when inflation was like it was, not only destroyed a generation of savers, but has just made every issue worse and destroyed the middle class. I know so many who worked hard their whole lives who will never retire. A mild recession after the tech bubble and 9/11, and I think lowering rates was a political move because Al raised rates in '92 and got blamed in part for Bush 1 losing. Once rates went under 3% it drove yield chasing and among other policies led to the meltdown of '08, and that bailout led to this giant bubble and class division between the ultra-rich and everyone else. The sad truth is this whole globalization thing, and much like the industrial age moving folks from farms to cities was not going to be an easy transition, has been made worse by policy. Coal jobs have been falling since the '20s for God's sake. But we are going from the industrial age to the technology age. I still think the math of a consumer economy that keeps reducing jobs and paying people less in terms of real dollars is doomed to not end well, but the Fed policy to avoid short-term pain at any cost has just made it worse. You can only say let them eat cake so many times before it becomes violent. I am glad I am old enough that even though my life's work has not turned out as planned, I may not live to see the end result of this mess that has been created by not dealing with the real issues. It was always going to be hard, but it did not have to be like this. Answer from Fleck. The Fed has stealthily, and not so stealthily, ruined so many lives. It is surprising that so few seem to understand who the real menace is. The dollar has been the obstacle for the rally in gold. Gold has a bullish setup, but the dollar has been standing in gold's way. Now there's a big reason why the dollar may not stay in gold's way much longer. By Rudy Frank and Jim Anthony via Streetwise Reports. Positioning, sentiment and market structure favor a powerful rally in gold. The cuts released by the CME on September 7, 2018. Show the gross speculative short position grew 1.3% to 213,259 contracts, just shy of the all-time record set 2 weeks ago. On a net basis, speculators are short 13,500 contracts, the largest short position since December 2001. The commercial net short position collapsed into negative territory for the first time since December 2001 at minus 6,525 contracts. In other words, commercials are now net long, a very rare occurrence historically seen only at major turning points. Nonetheless, gold continues to look weak, largely the result of a stronger dollar and market expectations of further dollar strength, which is putting pressure on gold, commodities and emerging markets currencies. Not surprisingly, speculators have been crowding into the dollar. There are four main reasons why the dollar looks to go higher despite U.S. political uncertainty, growing deficit spending and a worsening trade balance. Each of those reasons may prove to be short-lived. First, U.S. dollar-denominated debt offers higher interest rates than the debt of other developed economies, especially euro debt, which has attracted funds into the dollar. The key comparison here is the yield on the German 10-year note compared to its U.S. counterpart. Over the past year, the yield gap has widened in favor of the dollar until June when the trend has stalled, reflecting a 50% cut in bond purchases by the European Central Bank and an expectation that ECB buying will come to an end this December. If true, EU debt will fall, yields will rise, as the biggest and least price-sensitive purchaser stops bidding. We expect the yield gap will likely close. The second main support for the dollar is the market's perception of the U.S.-China trade war. In a nutshell, the market sees China and the Chinese economy as the losers while Trump and the U.S. economy are perceived to be winners before any serious damage is done to the U.S. economy and corporate earnings. Every time Trump implements a new set of trade sanctions, the dollar rises while the yuan, commodities and gold fall. This pro-dollar trade will unwind when markets begin to conclude there is no easy, early victory. We think this may be imminent. America's largest companies are now warning that Trump's trade policies are beginning to cut into their business prospects, and many are reporting serious upward pressures in pricing due to the tariffs and their disruption to established supply lines. Third, the U.S. has had the best performing stock market on the planet for the past 2 years, which has attracted global capital to the dollar. U.S. corporate earnings are up strongly, in part because of the magic of share buybacks but also because of the pro-business policies of the Trump administration. Regulations have been reduced and taxes have been cut. We think the tax cut has produced a sugar high, but its effect is already wearing off. Meanwhile, midterm elections are fast approaching and there is a real possibility that Republicans will lose control of the House to increasingly progressive Democrats, effectively ending the Trump effect. U.S. political uncertainty, growing deficit spending and a worsening trade balance may then begin to matter, all to the detriment of the dollar. Fourth, in our view, the dollar still depends primarily upon one thing: the perception of Fed policy. The Fed is tightening, steadily raising short-term rates and selling assets into the market for dollars it then extinguishes. The latter initiative will shortly reach its objective of removing $50 billion per month, a level the Fed has said it will maintain for years to come. The key question for the dollar is whether the Fed stays the course. The market assumes it will. We are less certain. We believe that Fed tightening will break the stock market and cause a reversal in Fed policy, which will have a dramatic impact on the dollar and gold. Even now, while the stock market remains strong, the Fed is laying down markers that support the end of tightening. First, Fed Chairman Powell says he is not concerned about imminent inflation. The latest Fed statement noted that market-based measures of inflation compensation have increased in recent months but remain low. Survey-based measures of longer-term inflation expectations are little changed, on balance. Second, the Fed has stated that it is watching to see if there is a negative economic impact from Trump's trade policy and the stronger dollar. Third, the yield curve is only 125 basis point increase away from inverting, a fact noted in the latest Fed minutes where some governors expressed concern that an inverted curve has reliably signaled oncoming recessions in the past. But especially, watch the emerging market currency implosions that now threaten more than 20 countries ranging from Turkey, Argentina and South Africa to Poland and Brazil. This growing crisis is directly attributable to Fed tightening thanks to the fact that emerging markets have incurred more than $3.7 trillion in dollar-denominated debt. None of these economies may be big enough to matter in a global context, but their impact on the global banking system may be another matter. Gold is sold out and should begin to rally. The obstacle is the dollar, but perhaps not for much longer.